Record high in January, down we go. World coming to an end, a VIX of 50. Down here, the percent change 1929, percent change 1987. Right here is where I went to cash, 100%. Everything right there. Levitt said no. Sowerby said no.
Cash is trash.
I went to cash, arrow up. David Sowerby, how many people in your world went to cash?
Very few. Whether it's institutional for investment committees they sit on, private capital clients, very few went to cash. If anybody did anything at the end of 2017, they upped their risk bucket on the margin, looking for the proverbial low correlated assets, but that was simply on the margin. Nobody went to cash.
OppenheimerFunds is expert at low correlated assets. Where are those assets right now? Because I'm in cash and I got to do something.
Well, I don't think that there was any reason to go into cash, and I'm assuming you're saying that in jest. This is not the end of the cycle. The end of the cycle is not going to be interest rates going up, the dollar weakening. We're going to see the end of the cycle. You're going to have interest rates coming down, a very strong dollar on the back of significant Fed tightening.
You didn't ask my question. Where do I put my money today? Emerging markets? Where is it?
I do. I think, the U.S. growth markets are going to do fine, but I also think investors are going to do better outside the United States. If you consider the last time we saw a lot of fiscal stimulus and Fed tightening, that was 04, 05, 06, international markets did very well in a stable to weak dollar environment.
Brian, let's take a step back. So where do you see interest rates in the U.S. by the end of this year, and where do you see them by the end of 2019?
Well, I think interest rates cyclically could move higher. So, this move down to 2.8, I think, could be expected because 3% and a 1% real yield actually looks nice to investors who haven't had a real yield in a while. Cyclically, growth probably continues to improve in the United States with some stimulus. So rates could perhaps trend a little bit higher. But I think importantly, secular forces are likely to keep interest rates low for the prolonged period of time. That's aging demographics in the Western world, high savings rates in Asia, and given where we are in the U.S. economic cycle, it's unlikely to see new, higher, sustained growth, sustained being the important word, in the United States. So I think over time you see rates stay in the 2.5% to 3% range.
David, do you agree with that?
As a former bank economist, full-time portfolio manager, it is hazardous, frankly, to forecast interest rates. More people have been right than wrong. Nevertheless, we are asked to give our best thoughts. I think by year-end, the 10-year is above 3%. I think they're going higher. I think 4% on a 10-year Treasury is the likely ending point with 2 to 2.5% inflation. That puts the real rate at about 1.5%. And as a result, long duration assets and fixed income look still very troubling. They've underperformed for the last 5 years. And you've got to think about when that crosses that point where it becomes problematic for stocks, and it's somewhere above 4% on a 10-year Treasury yield.